Hey, everybody, this is Sam Galovi. Today, we're going to talk about the Ukrainian Russian war conflict and how it is affecting the global markets, especially here in the United States. Hey, everybody, welcome to Sacramento's Real Estate Channel, where we talk everything there is to know about the brand new bills and, of course, what there is to do here in Sacramento. If you've been thinking about making a move to the area, subscribe to the channel. And just so you know, we go live every Tuesday at 5:30 p.m. We'll see you there. Well, there it is, guys. Welcome to the channel. Thanks for tuning in again with us on this lovely Tuesday evening. So I know things have not been easy, especially last week when war broke out in Ukraine after a Russian invasion. Things have definitely been pretty drastic over there, I would say. I actually have quite a few friends and family, extended family on both sides of the spectrum there. So I know quite a few people that are involved in being the boots on the ground. So not an easy time in the world right now. But I wanted to talk today about how this Ukrainian-Russian conflict, this war that's going on, is going to be affecting potentially the global markets and, of course, the financial market here in the United States, which leads to the real estate market. So I wanted to show you guys on a practical level how this could affect us and what we can do in times like these of uncertainty and certain things going on. So I'm going to read a few articles today. It's going to be a little bit of a different setup. Of course, you guys can always comment down below in the chat. Let me know your thoughts. Let me know maybe things that you have seen or heard or read. I would love to hear from you guys. So one of the main things is that a lot of the countries are talking about potentially banning Russia from SWIFT. And you may have seen that word around, and it's kind of been a trending topic right now. And so SWIFT is the global financial artery that allows the smooth and rapid transfer of money across borders. It stands for Society for Worldwide Interbank Financial Telecommunications. So basically, it's a system that helps you transfer money between banks, right? Especially across different countries. And why is this important? Because Russia is actually, and people in Russia are tied to a lot of other countries. Sometimes growing up in the United States, you don't really realize how other countries, other people from other countries are moving at a rapid pace into other countries where there might be more, let's say, opportunity, or even the United States is a super attractive place to buy real estate over most places in the world. So we have a lot of inflow of just investors, really high net worth people that will just come here and buy properties because it is one of the best places to invest, especially in real estate. So a lot of these money transfers are happening across borders for goods, services, other things, of course. But because of that, SWIFT specifically sends more than 40 million messages a day as trillions of dollars change hands from companies and governments. Okay, so this is very important. More than 1,000 of those messages are thought to involve Russian payments. So, of course, if Russia is basically blocked off from SWIFT, it's going to be a huge detrimental issue for them. And actually, a lot of their major banks have already been cut off or frozen, and have been already sanctioned by governments like the US and I'm sure others. But because of that, their stock market has actually plummeted drastically as well. The value of their dollar went down like crazy. Inflation went up. And I even saw some articles saying that their interest rates on the ruble went up to about 20% interest rate, if I'm not mistaken. So that's just crazy to even see that or hear that, of how things can change so fast, especially with sanctions being put in place. So if SWIFT gets taken out for them, it's going to be even more major, as you can tell. Why does this matter? This is not a like a political argument of whether we should or we should not, but it's just going to be talking about how this can affect the other markets that are maybe reliant on Russia or Ukraine, especially in this situation. So what is it going to do? It's going to tighten the money supply and money movement. So the less money that's being moved around, the harder it's going to be, the tighter money gets. And typically interest rates rise when money is tighter. Okay. So that's the first thing. Interest rates will probably rise. Another thing is that not as many goods and services will be transacted. of course, that's not good for the economy as well. One thing you should also consider is that I was reading this in another article that specifically a lot of people from Russia, multimillionaires, billionaires, oligarchs, basically really high net worth people, kind of a different social status and class, are actually buying a lot and have been for years. A lot of luxury homes in places like New York City, LA, and Miami, and these huge markets where it's multi-million dollar properties where they come and live lavishly. So if this SWIFT thing gets cut off or their assets get frozen in Russian accounts, it can affect real estate here just based on that level. I was already reading some articles that some people were in contract on these high-end homes and basically decided to pause or even cancel because of the conflict that's going on, really unsure of if they're going to be able to get their money out on time, and different, obviously, the different conflicts that can arise with that. So as you can see, there's already kind of like top of the funnel changes happening. And of course, uncertainty can change things in the short term as well. So that's one thing to keep in mind. Another thing I wanted to bring here is that this is actually from a article. It's called "How Russia and the Ukraine War Affect Us in the Housing Economy." This is actually from Realtor, the actual magazine for realtors, and they do a lot of economic stats and things like that. So I wanted to bring this in. And basically, they wrote, the conflict could put more pressure on rising oil and food prices as well, which could churn way more heavily on consumers' household budgets. Russia is the second largest oil producer in the world, and although the U.S. imports little Russian oil, the conflict could roil global energy markets, the Times reports. And here's the quote: If oil prices go up, that raises costs throughout the economy, which is true, says Danielle Hale. That's Realtor.com's chief economist. And she finishes off saying it means more inflation. And that's true as well. Russia, I believe, is number 1 or number 2 in oil production globally. So that could definitely change things in the global market and bring in more inflation, right? Higher costs of things. So that's going to be also a huge, basically changing the game. So we've already had a lot of inflation. I was doing this on a previous live. We looked at how much cash actually hit in America was printed, basically. So in the last 2 years, it's about 40% of all the cash ever printed in the United States was in the last 2 years, as far as what I've been reading. And so with that, inflation has been more than what the Fed was expecting. We all knew it was more. Let's be real. So a lot of stats came out saying that it was over 6%, over 7% inflation rate, even just for last year. So as you could see, the value of the dollar has definitely gone down. And with that, there's been a lot of talks of, okay, what can I invest in to hedge against this inflation? And so if this just basically adds more to inflation with this whole conflict going on, obviously you can see it's time to be really proactive with our money and what we're doing as far as investments. I want to keep reading a few articles before we kind of go too much further, and I'm gonna kind of bundle this up here in the next few minutes. So New York Times comes out with another article, I believe it's today, and it says the sanctions were designed to avoid disrupting essential energy exports, which Europe in particular relies on to heat homes, power factories, and fill gas tanks. That helped dampen, but did not erase a surge in energy prices caused by war and anxieties about disruptions in the flow of oil and gas. Here we go. Worries about shortages also pushed up the price of some grains and metals, which would inflict higher costs on consumers and businesses. Russia and Ukraine are also large exporters of wheat and corn, as well as essential metals like palladium, I don't know how to say that, aluminum, and nickel, which are used in everything from mobile phones to automobiles. So iPhones and Teslas. Just kidding. So as you can see here, higher costs basically transfers to most consumers and businesses, aka also inflation, right? Dollar just does not go as far for the same goods. So with that being said, and of course, one of the huge driver is going to be oil and gas. So the tighter we put sanctions on basically Russia, as you guys have probably even seen, red trends, the barrel of oil, I believe, went up over $100 recently. So you can see, we're definitely going towards an inflationary page in history if this keeps happening. I want to also finish off with this BBC article that came out. And if you guys are interested in these, I'll link these all down below so you can check them out for yourself. And they wrote that inflation, which measures how fast the cost of living rises over time, hit 7.5% in January in the US. So there it is, that 7.5%. That is the highest level seen since February 1982. So inflation is the highest level it's seen since February of 1982. They also write that it rose by 5.5% in the UK. But it could hit close to 10% in major Western economies if the cost of energy and food is pushed up by dwindling supplies caused by the Russian-Ukraine conflict, according to the Center for Economics and Business Research. Such a figure might encourage the U.S. Federal Reserve or the Bank of England to increase interest rates. The idea is that when borrowing is more expensive, people have less money to spend. As a result, they will buy fewer things and prices will stop rising as fast. Okay? So as you can see here, we're kind of set up to potentially be going into more or higher rates of inflation. Okay. And that's not to scare you. I shouldn't say, but I'm just not as worried about it, right? We're being proactive about it. We're talking about it. That's why I'm bringing this on the channel today. So inflation, what's the best way to hedge against inflation? Of course, it's with active investment, making your money work for you, essentially investing. Some people might invest in stocks, different assets, gold, silver, whatever it may be. Obviously, I'm a big proponent of real estate. Just last year, we were reviewing some of the trends. Here in the Sacramento County, most neighborhoods increased 15 to 18% in value just last year. Okay, so when you have a 6-7% inflation, but then your home is increasing at a higher rate than that, that is hedging against inflation. Basically, it's protecting your dollar value and, in fact, increasing your dollar value, making sure that you just don't have money sitting in an account that's technically losing its value every year, right? So with this as well, as inflation goes higher, rates are most likely going to go higher as well. When we had this conversation, I believe on a few lives ago, the Fed came out and said, you know, the inflation rate is higher than we were expecting, so we're probably going to have to increase our rates higher or quicker, right? And you saw right away that the interest rates jumped up. We were hovering right around a 3.5%, and then we went right up to over 4%, like almost in a day. So because of that, you can see that the more inflation comes, the higher the interest rates are going to be because money gets more expensive. So with that, if you guys have been thinking about getting a home, if that's been on the thought process, this would be the time to do so because rates are still hovering more or less around 4%, which is still a historical low. Most people don't realize this, but rates have been much higher in the past. Check out the 70s and 80s and just look at what kind of interest rates people were getting back then. I've heard of 12, 14, even up to 17% interest rates back in the day. So when we're looking at 3-4%, it's not going to change your life, you know. But if you're thinking about doing it, why not do it sooner than later? Because the supply and demand, I mean, the demand for homes has been crazy. We actually just listed a home 2-3 days ago, right before the weekend, ended up getting 10 offers on this home. Now, of course, it was a starter kind of home that I was selling for one of my investors, but went substantially over the list. There's still a huge demand for housing. We just got another contract in home, brand new home in contract this morning as well in 12 Bridges, which is awesome. Really excited about that one. But prices, it seems like every time they do a release, even on new builds, it's just another slightly higher price every time as we continue throughout these neighborhoods that are being built in. So that's just something to consider. If you guys are looking to park your money, of course, no one likes this crisis going on. I don't think any of us are really happy with it, no matter where we sit on either side of this. But I hope that this helps you guys. I hope that you've enjoyed this. I want to know your thoughts in the comment down below as well. And just want to remind you guys that we are live every Tuesday at 5:30 p.m. We'll see you next week.